Hi everyone, it's Grace. Welcome back to my channel. So there's this huge debate that the US government may run into default if it doesn't raise the debt ceiling by next month. So in today's video, we're going to analyze what the government will do and its impact on the stock market and the housing market. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. What is debt ceiling? I'm glad that in the poll that I did earlier, 2/3 of you know what it is. And for those of you who don't know what a debt ceiling is, it determines how much the US government can borrow from the public. So it's basically a tool that is used to adjust the macroeconomic policy. Up until recently, it has been brought up again to the spotlight because it has a direct impact on the US economy. It is first introduced by the Congress in 1917 in the Second Liberty Bond Act with a limit of $11.5 billion. So it is a necessary measure for the government to controllably borrow money and stimulate the economy. You might ask, if there's a risk of default, to prevent it, why does the government need to borrow more money if the Fed can just print the money to make the dues? We mentioned that the Fed controls the money supply, but it doesn't print money by itself. The Treasury prints money and issues Treasury securities under the direction of the Congress, and the Fed makes asset purchases. So the result is that cash is released into the market while the Fed holds the securities. When the securities are due, the government repays with interest. Over the years, the debt ceiling rule helps the government keep the interest rate low and borrowing easier. But there are limits as to how much money can be printed and borrowed. Since the government needs to repay for individual and entity securities holders in benefits and repayment with interests, the first side effect is that if it runs out of money to pay for its creditors, it will set off a default. And Treasury securities will no longer be seen as a safe and risk-free investment, and its ranking in the Fitch ratings will also be affected. Creditors may sell off the Treasury securities and the interest rate will increase. The second side effect is inflation. Since dollars flood the market, commodities, energies, merchandise, real estate, and just about anything gradually get more expensive. We've seen this over the past year or so. And it makes the economic situation much more severe because of the shortage in labor and materials, and continuous disruptions in the supply chain because of the pandemic. If money is overprinted, it will eventually lead to double-digit inflation or hyperinflation, where the dollar bill is practically worth nothing and leads to permanent destruction of the economy. So why not just raise the debt ceiling in a timely manner? It's important to understand that Treasury securities have never been defaulted before. The Congress just simply keep raising the debt ceiling and keep borrowing. Essentially, it means that it borrows new debt to pay off old debt. The debt ceiling has been raised for about 100 times since World War II, but carrying a higher deficit will prompt too much debt in the system and run higher default risk. That's why the debt ceiling is sometimes under suspension. The most recent suspension is from August 2nd, 2019 through July 31st, 2021. We can see the exponential growth trend of the debt ceiling and the national debt. Since the debt ceiling has been raised for so many times, now it doesn't seem to be working like before without causing major concerns. When the debt ceiling is reached, the Treasury will use what's called extraordinary measures to suspend some payments and move funds around from one account to another to avoid default. The extraordinary measures include some accounts like Civil Service Retirement and Disability Funds, Postal Service Retiree Health Benefits Fund, Government Securities Investment Fund, and Exchange Stabilization Fund. However, by October 1st, 2021, the extraordinary measures will be depleted. Raising the debt ceiling becomes a much more difficult decision to make when the default risk is getting bigger. So what happens if the government defaults on the Treasury securities? If the debt ceiling is not further raised, we may see a government shutdown starting October. And almost every aspect of the economy may see negative impact. More importantly, the US stock market and housing market may face substantial crash. Let's take a look at who holds the Treasury securities to further explain this. The data comes from the second quarter of 2021 by the Securities Industry and Financial Markets Association, which gathers and monitors data published by the US Treasury. The total Treasury securities holders from large to small include foreign governments, which is $7.2 trillion. I did a quick poll yesterday, so for those of you who says foreign governments, you're right. Next is monetary authority. basically the Fed itself at 5.6 trillion, and then mutual funds at 3.7 trillion, pension funds at 3.2 trillion, banking institution at 1.4 trillion, individuals at 1.3 trillion, state and local governments at 1.3 trillion, insurance companies at 0.4 trillion, and others at 0.3 trillion. So the current total treasury securities amount is at 24 trillion. The top 5 foreign governments that hold the treasury securities include Japan at 1.3 trillion, China at 1 trillion, UK at 0.5 trillion, Ireland at 0.3 trillion, and Switzerland at 0.2 trillion as of July 2021. So you can see the scale of impact if treasury securities go into default. So how much trouble is the government in right now? What you should know is that the current debt ceiling was set at 22 trillion as of June 30th, 2021. But the total national debt level is already at 28.5 trillion with an extra borrowing of 6.5 trillion. So what the debate is saying is that the current debt ceiling should be raised to 28.5 trillion, the current debt level, to allow the government to continue borrow money into the future. But given the government's current situation, there is no easy solution to how that can be done. Let's take a look at the current financial status of the government according to the Congressional Budget Office. The estimates for the third quarter of 2021 includes revenues of 786 billion and expenses of 1.5 trillion. So the cash outflow is almost twice as much as cash inflow, and the government is running into liquidity issues. The following payments are possibly the most important accounts held by monetary authority. They are Social Security, Medicare, and military benefits, which belong to accounts in monetary authority, which are non-marketable treasury securities held by Federal Reserve Credit Facility LLCs. So in the third quarter of 2021, Medicare Advantage and Medicare Part D totals 105 billion. Social Security totals 246 billion, and military benefits totals 75 billion. These three categories totals 426 billion, and they're probably amongst the priorities of the priorities, and they have to be paid no matter what. And for the rest, some of the creditors will probably not see timely repayments, which means that the government may go into debt ceiling suspension and shutdown. What suspension essentially means that it goes into somewhat of a forbearance. But since the government will shut down, nobody goes to work and no payment is made until some kind of a solution is come up. So the dilemma here is that if the debt ceiling is not raised, treasury securities will go into default, which will lead to financial crisis and economic depression. If the debt ceiling is raised, the government will no longer be able to issue new debt because it's already having trouble paying off current debt. So now it's at a lesser of two evils situation. So if the government goes into default, how does it affect the stock market? The stock market is highly sensitive to the treasury yield. If it goes into default, its ratings will be downgraded, the yield will go up and drive down the stock market. Major stock markets all see the influence with the growing possibility that treasury securities will go into default. Dow Jones fell by 500 points, S&P 500 fell by 90 points, and Nasdaq fell by 400 points within a day. So if the government actually defaults, it will most certainly lead to sell-offs and the stock market price will crash down. And how will the default affect the housing market? The most important principle to remember is that fixed primary mortgage rates are positively related to 10-year treasury yield. Let's compare the graphics side by side. So you can see that the 30-year and 15-year fixed mortgage rates match the trend of the 10-year treasury yield. So if treasury securities go into default, the yield will increase and so will primary mortgage rates, which basically means that the cost of getting a mortgage will be higher and it will be harder to get a mortgage. Additionally, the housing market is also highly influenced by the supply and demand. I explained in one of my videos why the housing market may crash under low home supply. Click here to check out that video. The supply side is not something that can be fixed in a short run because the labor and material cost will stay high as long as the pandemic is still going on. On the demand side, the situation may shift for corporate buyers in the current housing market. If the treasury yield increases, it will also affect other interest rates, increasing the cost of borrowing in the private sector. The basic principle is that when interest rates increase, it becomes more expensive to borrow money. and corporates are more likely to run into liquidity issues and will probably see layoffs, asset sell-offs, and even bankruptcies. So generally speaking, yield hikes will cause the housing inventory to increase and the price to go down over time. And I will explain more about this in the future. The last question is, what do we expect on October the 18th? In my honest opinion, I think a partial default is almost unavoidable at that point. It means that the government cannot infinitely issue debt. It must pay off current debt before it's allowed to issue new debt again. Top priority creditors must be paid off first, and others may be partially paid off or not paid at all. So this is today's video about debt ceiling and its possibility of the upcoming default. As always, thank you very much for watching, and I'll see you on the next one.